contracts. So that bank will contact another bank and say, right, what price will you do me 7,700 contracts on the ZB for? Well, when you look at the current price, that conversation was obviously the reason why this block transaction prints when the transaction is completed, not when the transaction is being initiated. Okay? So this block transaction takes place when the initiation is now in place, when it's been completed, right? And it shows the average price, not because that average price isn't all the prices. If I want to do 7,700 contracts, the reason why the block exists in the first place is because it means that you can basically get your fill before anybody knows about it. But obviously that's up to the counterparty to agree an average price, an actual price for this. So if you were the counterparty agreeing a price, let's assume this was a sell order, because where the average price seems to suggest it was a sell. Okay, so this is a sell order. So somebody comes to you and says, I want to sell 7,700 contracts. Okay, and this is what the chart says at that point. You can see the time at the bottom is 15:60. It's just coming into 15:16, right? So that's the same time on the time frame here. So when somebody comes to you and they want to sell 7,700 contracts, are you going to give them a price of 18? Well, if you did, you'd be the most generous trader on the planet, right? You'd be saying, you basically you wouldn't be in the business for very long, would you, if you gave them a price of 18? Because that's a market price. This guy wants to offload 7,700 lots, or buy, or actually buy or sell 7,700 contracts. So obviously there's no way you're going to give them a price of 18s. So you start hedging out that exposure. You start hedging out that exposure. So what you do is, if you're going to be buying 7,700 contracts, you start selling some of those in the futures markets as much as you can get, right? You start selling some in the futures markets. Now you might say, but is this not likely to be part of the same trade? Well, you know, maybe. I mean, but it's difficult to know exactly, but we can only see what happened next. And then the next big volume candle comes in. You can see there's another huge volume candle, and this is averaging a 13s, 14s price. And again, you'd imagine that this guy that's looking to try and set up an average price, they're selling all of these prices, every single price, because they've got to try and get that business transacted. They've got to try and get that business transacted. By the time they get 11, remember the average price this guy gets is 11. This is why I know it's most likely to be a sell order, because it's most likely to be a sell order because the price is below the marketplace. If we look at the time on the actual time ticket, we can see it's 9:16 and 41 seconds. And at 9:16, 41 seconds, there's 9:16 and 40 seconds right there. There's 9:16 and 40 to 45 seconds right there. The price was 14s at that stage. So if the price is 14s at that stage, these guys can still sell into that down to 11s, can't they? And still make a little bit of profit, 3 ticks on whatever they've got remaining. So they sell more here. So if you see that in real time, you can obviously sell this down to 11s. So you could sell 14s, you could sell 15s, and you can see what happened. The price then traded down through the 11s following that release. It doesn't leave you a lot of time to get that trade on, because where this upright is, that's where this data is finally finished. Their order is completed. Their order is completed at an average price of 11s. And obviously when that gets reported, of course, these guys may still be in an open position that they're trying to sell off. And obviously if they can sell it down to 11s, they've made a profit on the deal. So obviously that's exactly what happens. So you can see all that selling comes in and pushes the price down to 11s. And there's a high probability that they have made a high probability, there's a possibility that they've made a profit on that deal by giving them an average price of 11s. So this is why most of the time when we talk about the likes of a block trade, if it's towards the bottom edge of a bracket from the current price, it's more likely to be a large sell order. If it's towards the top edge of a bracket, it's most likely to be a large buy order. Have we covered this before? Yeah, absolutely. So when we look at this idea of the price and we start thinking about this process, we start considering the idea about this sell-off. This isn't known to you at the time that there was a big block, but it's obviously known to somebody that's doing the block trade with these guys. The person that's agreed this actual block order is the guy that's obviously given this big push to the downside. And obviously if you see the block order fast enough, you know what it is. It's a sell order, and if the price is below the current price, you know there's still a lot of hedge selling still to come in until that price averages out. So, you know, the guy wouldn't have accepted 11 unless they believe the price is going to go through 11. Otherwise, they wouldn't have done a deal, right? They would have just have waited and they would have done their own business at higher prices. But for the guy to accept 11, that's telling me that they believe that price is going to go even lower than 11. And that gives you a good quality idea that from this point here, there's a very, very reasonable chance of making some money on that trade. This is why we keep talking about things like a block order. If you're sitting watching block prints for whatever, and the block print suddenly comes in here, the price comes in at this point here, and we get a big block print coming in at this price, that's likely to be a big buyer in terms of the block trades. I'm not talking about the block trades you can see actually trading on the likes of your screens. I'm not talking about those kind of block trades. I'm talking about off-exchange block trades. So when we see these off-exchange block trades, if I see an off-exchange block trade at that price, there is an incredibly high probability that that is a buy order, because that block trade actually may be well above the current market price. There's a lot of times that when that block trade comes out here, the current market price might be here the way it was in the bonds case. And obviously when you see that kind of gap, that kind of discrepancy, the idea is that that price is going to go at least to this price here. Otherwise, why would they ever have agreed that price? They would never have agreed that price, right? So if they're never going to, if they're never going to be agreeing that price unless the price is going up to there, it gives you a fair amount of room to be a buyer through that process to get to that price print just there. Gives you a fair amount of opportunity to make some nice easy money on the back of these block trades that start to show up. And then this is a great example of it from the bonds here, because you can see what happened to the bond. It just kind of kept selling off quite nicely right through that process. And we've sold from 12s down to 25s now in treasuries, 12s down to 5s. And that's absolutely fantastic, isn't it? A brilliant little trade, brilliant little outcome, and some pretty good cash as well, guys, pretty good cash.